Title: Crypto Market Brief for May 15th, Bitcoin, ETF Flows, Clarity Act, and Security Risks. Educational only. Not financial advice. Bitcoin is back under $80,000 this morning, Ethereum is softer, ETF flows have flipped negative, and Washington has a major crypto regulation vote on the calendar. That sounds like a lot. So today we are going to keep it simple and useful. This is not a price prediction video. It is not a buy or sell recommendation. It is a framework for understanding what is actually moving crypto right now, ETF money, regulation, macro conditions, and security risk. During production for this May 15th episode, Bitcoin was fluctuating around the $80,000 area. Crypto.news showed Bitcoin near $79,900, Ethereum near $2,257, and Solana near $91. Other market feeds showed Bitcoin moving between the high 79,000 area and the low 82,000 area as the session developed. Those numbers may change by the time you watch this, but the lesson is more durable than the tick-by-tick move. When Bitcoin loses a big round level like 80,000, people usually rush to explain it with one headline. But markets rarely move for one reason. Today's better explanation is that several forces are pushing at the same time. First, ETF flows. Second, regulation. Third, interest rates and liquidity. Fourth, security risk. Let's start with ETF flows, because this has become one of the cleanest institutional signals in crypto. The latest available flow data being reported during production showed spot Bitcoin ETFs with roughly $630 to $635 million in net outflows on May 13th. BlackRock's IBIT reportedly accounted for about $285 million of that. ARKB and FBTC also saw notable withdrawals. Why does this matter? Because spot Bitcoin ETFs are now one of the main ways traditional investors get Bitcoin exposure. In earlier crypto cycles, the market was dominated by exchange traders, offshore leverage, and retail speculation. Those things still matter. But now ETF flows give us a more visible window into institutional risk appetite. If ETF inflows are strong for weeks, that usually supports the adoption narrative. It suggests portfolios, advisors, funds, and institutions are still adding exposure. If flows suddenly turn negative, it does not automatically mean the bull case is dead. One day is not a trend. But it does tell us that some investors are reducing risk. For beginners, here is the simple rule: watch the flow trend, not just the price candle. A price dip with steady ETF inflows can mean the market is absorbing selling. A price dip with large ETF outflows can mean the buyer base is stepping back. That second setup is more fragile. This is why today's Bitcoin move matters. It is not just that Bitcoin is under 80,000. It is that the move is happening while ETF flows are negative in the latest data. That combination deserves attention. Now, Story 2, Regulation. The major US policy story this week is the Clarity Act. PYMNTS reported that the Senate Banking Committee was scheduled to mark up the bill this week, ahead of the May 15th publishing window. A markup is where lawmakers debate details, amendments, and whether a bill has enough support to move forward. The Clarity Act matters because US crypto has spent years stuck in a basic question: who regulates what? Is a token a security under the SEC? Is it a commodity under the CFTC? What rules apply to exchanges, brokers, custodians, and trading platforms? What disclosures are required? What does compliance look like for a company that wants to build in the United States? That uncertainty has been expensive. It slows product launches. It scares off conservative institutions. It pushes some companies offshore. It also creates confusion for ordinary investors. Clearer rules could be constructive for the industry, especially for assets and businesses that can meet serious compliance standards. But regulation is not automatically bullish. A stricter rulebook can also expose weak projects, pressure offshore platforms, and make it harder for low-quality tokens to survive. So the honest read is balanced. If the Clarity Act process creates a workable framework, it could help banks, ETF issuers, custodians, exchanges, payment companies, and public companies participate with less legal fog. That is potentially constructive over time. But if the details disappoint the market, or if the bill stalls, the short-term reaction could be cautious or negative. Crypto likes clarity, but it also reacts to the fine print. For Bitcoin, regulatory clarity is usually the cleanest story because Bitcoin already has the strongest institutional identity. For Ethereum, clarity can also help, especially if ETF demand and infrastructure adoption keep developing. For smaller tokens, the outcome may be more mixed. Some may benefit from clearer paths. Others may face more scrutiny. The takeaway is not regulation good or regulation bad. The takeaway is, regulation changes who can participate. Now let's talk about macro, because this is the part crypto investors love to ignore until it hits them. Crypto does not trade in a vacuum anymore. Bitcoin and Ethereum now sit inside the same global risk system as equities, rates, the dollar, liquidity, and inflation expectations. Recent Fed-related context still points to a cautious environment. The last FOMC meeting was in late April. The next one is scheduled for mid-June. Search results citing Fed context showed the target federal funds range remaining around 3.5% to 3.75%. That matters because higher for longer rates can pressure risk assets. When safe yields are attractive, investors do not have to reach as aggressively for volatile assets. When liquidity tightens, leveraged positions become more vulnerable. When inflation worries rise, markets can quickly shift from risk on to risk off. This is why a positive crypto headline does not always cause a rally. You can have regulatory optimism and long-term ETF adoption, but if macro conditions turn sour, traders may still cut exposure. Think of ETF flows and regulation as crypto-specific catalysts. Think of rates, inflation, and liquidity as the weather system. A strong catalyst helps, but bad weather still matters. That brings us to story 4, security risk. TRM Labs reported that North Korea-linked groups accounted for about 76% of crypto hack value in 2026 through April, driven by just 2 major attacks. That is a giant number, and it is a reminder that security is not a side topic in crypto. It is part of the market structure. A lot of people think crypto risk means the price might go down. That is only one type of risk. There is custody risk, who controls the keys? There is platform risk, what happens if an exchange or custodian fails? There is bridge risk, what happens if assets move across chains through vulnerable infrastructure? There is smart contract risk, what happens if code behaves in a way users did not expect? There is social engineering risk, what happens if a signer, employee, founder, or user gets tricked? And there is physical and operational risk, what happens if someone becomes a target because they advertise wealth online? Security incidents affect prices because they affect trust. A major hack can pull liquidity out of DeFi, damage confidence in a chain or exchange, and invite tougher regulation. Institutions especially care about this. They are not just asking, can this asset go up? They are asking, can we custody it safely, audit it, insure it, and explain the risk? For beginners, the lesson is simple: if a yield looks too good, ask where the risk is hiding. If a platform promises easy returns, ask how custody works. If a protocol depends on a bridge, ask what happens if that bridge fails. If someone pressures you to move quickly, slow down. The SEC has repeatedly warned that fraudsters use hype, social media, fake platforms, and urgency to lure people into crypto scams. That warning fits today's market perfectly. Volatile news days create emotional traders, and emotional traders are easier to manipulate. So what is the setup now? I would describe it as neutral to cautiously defensive in the very short term, with constructive long-term themes still intact. The constructive side is that Bitcoin is still deeply integrated into institutional products, regulators are trying to build clearer rules, and crypto infrastructure keeps maturing. The defensive side is that ETF outflows are a warning sign. Bitcoin is below a visible round level, macro conditions are not obviously easy, and security risk remains elevated. That does not mean panic. It means confirmation matters. Here are the 3 things to watch next. First, ETF flow streaks. One outflow day can be noise. Several outflow days in a row would be more meaningful. If flows stabilize or turn positive again, that would calm the story. Second, the Clarity Act process. Watch whether the bill advances, what amendments appear, and whether the market sees the details as workable. Third, risk conditions outside crypto. Inflation, rates, dollar strength, liquidity, and equity market risk appetite can all overpower coin-specific news. And I would add a fourth, security headlines. Hacks, exchange problems, bridge exploits, and wallet compromises can shift sentiment fast. The most useful beginner framework is for questions. Is institutional money entering or leaving? Is regulation becoming clearer or more hostile? Is macro liquidity helping or hurting risk assets? And is the crypto ecosystem becoming safer or more fragile? If most of those answers are positive, the market foundation is healthier. If 2 or 3 turn negative at the same time, caution goes up. Today, the answers are mixed. Institutional flows look weaker in the latest data. Regulation could become clearer, but the details still matter. Macro is still a headwind risk. Security remains a serious overhang. That is why the honest message is not hype. It is discipline. Do not let one red candle scare you into bad decisions, and do not let one bullish headline convince you risk disappeared. Crypto rewards people who understand uncertainty better than people who pretend certainty exists. To wrap up, here are today's key takeaways. 1. Bitcoin under 80,000 is notable, but the bigger story is ETF outflows and risk appetite. 2. ETF flows are one of the clearest institutional demand signals. Watch the trend, not one headline. 3. The Clarity Act could be important for US market structure, but regulation is only bullish if the details are workable. 4. Macro still matters. Rates, inflation, liquidity, and the dollar can overpower crypto-native narratives. 5. Security risk is market risk. Hacks, scams, custody failures, and social engineering are part of the real crypto landscape. That is today's crypto market brief. Bitcoin is under 80,000, ETF flows are flashing caution, regulation is the big policy catalyst, and security risk is the warning sign that never goes away. Follow for simple crypto and finance lessons without the hype. Educational only. Not financial advice.